Poly market, 78% odds that this is going to go against the president. What do you think?
Well, if you listened to the questions that the Supreme Court justices asked, it did seem that they were quite skeptical that the president's use of tariffs under this national security emergency authority actually was appropriate. So it's a very important decision. It doesn't mean that tariffs are suddenly going to drop in the U.S. because the president has other authorities, but it would very significantly constrain the president's discretion to do what he's been doing, which is make announcements of tariff levels and have them go into effect without any congressional involvement.
All right. I know you've been on the road, but you've been following the markets as you normally would as well. Do you think markets are priced for that kind of outcome? And if that is indeed what we get, what happens?
Well, if the Supreme Court rules against the president's use of this authority, there are subsequent questions that are still very unclear, the most important of which is to what extent would the administration need to make refunds? A very messy process, could take some time, and would really put a dent in the revenue estimates that they are getting from tariffs. And don't forget, their sole focus really has been on maximizing revenues from tariffs to make up for the tax revenue losses associated with the big, beautiful bill. Yeah. So those things, I think the markets still are going to need to digest, but it will be possible for the administration to quickly use other authorities to put in place. For instance, they could move right away to put in place a 15% tariff on all countries where we have a significant bilateral deficit. And of course, they're going through a variety of sectoral investigations that could still leave high tariffs on things like steel and cars and pharmaceuticals, the sectors that are most salient for the president.
Yeah, these are the 232 sanctions, and chips as well, semiconductors. They haven't dropped yet either. Something we're continuing to watch. So, what you're basically saying is, even if the ruling goes against the president, it may not necessarily hurt the U.S. fiscal position.
Well, I think it really depends on whether there is a decision that refunds need to be issued broadly. That would be a large number and could make a big difference in the revenue collections that the administration has been counting on. But it's enormously complex to do that. If they come with a more narrow, prospective-oriented decision, then the revenues implication is much less because the administration can move very quickly to put other measures in place. However, again, what's really important is that the president's ability to simply announce he's going to slap a big tariff on a country because he doesn't like something that they're doing politically, that will be greatly constrained because it puts back that important role for Congress, because tariffs are, of course, a revenue measure, and Congress has traditionally had the authority over revenue measures.
Indeed, that probably be a relief to a lot of people. I know you've been traveling, but I'm sure you've been following the news. Earlier this morning, we've been talking a lot about the two tanker seizures, right? And I know in your previous life at Treasury, you were not part of OFAC at all, nothing to do with sanctions. You were more G7, G20 currencies, et cetera, right? But in terms of just how audacious some of these actions were, going back over the weekend with Venezuela, what are your thoughts?
Well, I think the president and his cabinet have signaled a very intense focus on resource politics. They're very focused on oil, and Venezuela is very much, I think for the first time, we saw the president being very explicit about his focus on oil production and maximizing the capacity out of Venezuela, getting U.S. companies back in. Chevron, of course, is already in Venezuela and producing there, but that will take some time. And with regard to oil markets, of course, oil markets are very well supplied right now. The price is at the bottom of the range that would actually bring additional supply and real exploration activities online because the price is already soft. So it's not clear what these implications might be for oil in the near term. But of course, over the medium term, having those vast reserves in Venezuela be more accessible to the international market is a very significant potential. But loads of obstacles remain between here and there, given Venezuela's history of nationalization that goes back decades.
Indeed. Yeah. Sherry, come in on this.
Yeah, Lael, it's great to have you back on the show as well. And how do you feel about what the Trump administration has been doing in terms of shaking things up, the relationship between the public and private sectors, and really just putting it out there, not even hiding it, that we are going to put some sort of a sovereign put for these energy companies that actually stay aligned with our goal in countries like Venezuela?
Well, I think that there is a much broader question about this administration being much more interventionist with major U.S. companies. I mean, you look at the case, for instance, with NVIDIA chips, where they allowed additional export controls to be lifted on the condition of a 25% revenue share with the U.S. government. You look at them taking a share in Intel. This is a very different, much more statist and interventionist approach in the U.S. private sector than I think we've seen.
And how much of this do you think, this as in the Venezuela development over the weekend, was really about defending the petrodollar? Do you think this move by the Trump administration suggests anything in terms of the policy urge for the dollar? Because I'm just really talking about the context of China doing a lot of these oil trades with countries like Venezuela in its own currency rather than the U.S. dollar.
Well, I think the rationale associated with our own hemisphere, that is how the president's team talks about this, citing back to foreign intervention in our hemisphere. That is very kind of harkens back to a previous era. Administrations for decades have changed the American approach to support countries in the region with self-determination, trading through private sector mechanisms and trade agreements, not through direct intervention. And of course, China's active involvement with Venezuela, I think, is a motivating force for the president and his team. He certainly talks about it, but that has not been the traditional policy of American administrations for the last several decades.
Do you think this administration is worried about the reserve currency role for the U.S. dollar?
So, look, I think the role of the dollar very strongly depends on foreign confidence in several institutional underpinnings. First, the independence of the Fed, the ability of the Fed to control inflation. Secondly, rule of law, respect for international agreements. And third, of course, is fiscal sustainability. If the president's team were really focused on those institutional underpinnings for the dollar, they would not be threatening to fire members of the Board of Governors of the Fed and pressuring the chair of the Fed. They would not have blown up our national debt by another $4 trillion. And they would be much more circumspect with regard to the role of Congress domestically and international agreements. So I think the focus on the dollar is not the central focus here. I think this is really resource nationalism. It's real interest in, on the one hand, oil, and of course we haven't talked about rare earths.
Yeah. Do you think this Venezuela-related developments or even Trump's push for Greenland, given Chinese a stake or interest in those areas, do you think these developments rattle the U.S. and China trade truce that we thought we had at the start of the year?
Well, I think the intensity with which this administration is talking about Greenland and, again, setting aside questions about international agreements and respect for the international order, but just in terms of why is this issue rising to the top of the priority list for this administration, it really, I think you can trace a direct line to the weaponization of rare earths control by the Chinese Xi administration. And that concern about rare earths has really skyrocketed since the Chinese have threatened and, in fact, impose some constraints on rare earths exports, given their dominant position in rare earths processing in particular.
Well, I want to get back to what used to be your bread and butter for many years over at the Fed, right? We're looking ahead to the jobs report, which drops on Friday. And, you know, the question a lot of people are asking right now, we can get to the whole issue of the politicization of the Fed. It might be easier for you to talk about now that you're out a little later on. But I'm curious, does the Fed need to cut? Should it be cutting more?
Well, I think we are going to learn more, actually, tomorrow, U.S. time. I mean, that jobs report is going to be extremely important in the Fed's thinking. We've gotten some indications. We have the ADP report. We had the JOLTS report. Those two, putting them together, we had the two ISM reports, manufacturing and services. Manufacturing weaker than expected, services stronger than expected. And if you looked at the ADP numbers, I don't put much stock in them, but they are one data point. And you look at JOLTS, essentially the labor market looks like it is holding steady, cooling, but holding steady. So I think what will really matter is if we see a jump in the unemployment rate. The last numbers we got coming off of the shutdown were hard to read. You still had a lot of government employees coming off of those payrolls. I think we'll get a cleaner read tomorrow and then again in a month's time. And if the labor market is holding, I could imagine the Federal Reserve holding through January and possibly even March. But if the unemployment rate jumps, I think you'll see a Federal Reserve that does need to soften the interest rate and support the job market.
Okay, let me ask you, what happens when the chair changes? Or are we going to see an even more dovish Fed even before that?
So I think what you will see now, given the minutes coming out of the last meeting, is it's a finely balanced decision, the last cut. And having had 3 insurance cuts in a row, I think the general proclivity suggested by those minutes was to hold, at least for a meeting, and see how that is playing out in the economy. The other thing that is very important is we expect to see the U.S. economy gaining strength in the first quarter, in part because of the tax cuts, in part because of the AI boom, and large part also because of the bounce back from the shutdown. So in that environment, it makes probably sense to hold again, as long as the unemployment rate doesn't deteriorate very quickly. Okay. So you could see a cautious Fed going into March, and then the big change coming in May when the new chair presumably will be confirmed and appointed. And at that juncture, I think the market is anticipating perhaps 2 cuts in the second half of the year. That will depend on the data between then and now. And of course, if the economy, which I don't expect, is slowing more rapidly, then I could imagine more cuts. The other thing to keep in mind is that the inflation associated with tariffs will have peaked around the same time. And so committee members will presumably have more confidence that inflation is not going to continue to rise.
Got to ask you this is kind of a tricky question, but I'll leave you to navigate it. I mean, why does the president continue to talk about wanting rates down at 1%? Is it too simplistic to think that, okay, it's because Treasury's funding is still very much at the short end, right? And what they're trying to do, why they're pressuring the Fed and why the president wants rates at 1% is because it wants a cheaper cost of servicing of the U.S. debt.
Well, the president has said this. He said it several times. He said, you know, every percentage point cut yields $300 billion annually in lower interest rate costs. So it's really important to see the federal funds rate go down to 1% because that's a $1 trillion savings on our interest rate costs. Now, I think most people who carefully follow monetary policy know that if you were seeing cuts to 1%, that would be a recession, and that would not be good for the U.S. economy. In fact, most people think that the interest rate at which the economy would be neither subject to inflationary pressures nor decelerating pressures from interest rates is perhaps 3.25 percentage points at this juncture. And so beyond that suggests that a real concern about a weakening in the economy.